Well, Dan Mayo is a partner at WITHUM, and he's here to show us how to save on our taxes. We say good morning to you, Dan.
Good morning. How are you?
I'm very well, thank you, sir. Just 7 weeks, 6 weeks, 6 weeks. That's right, until tax time. This is your busy season. So tell us what are some of the key changes in 2026 that individuals need to know about, especially regarding their deductions.
Yes, there's a lot of new deductions out starting in 2025 for the 2025 tax year and in 26. Many of them, though, are temporary provisions that last for a couple years. So we start with this provision that gives a deduction for senior citizens. They can deduct up to 6,000 per individual for the years 2025 through 2028. And that deduction phases out at certain income levels, but it is a new deduction that was passed as part of the One Big Beautiful Bill Act. We also have the
Very
deduction for tips and overtime, also from years 2025 to 2028. And for tips, that's up to 25,000 per individual. And for overtime, that includes the half time in the time and a half phrase that everyone thinks about. And that's based on the Fair Labor Standards Act, the definition of time and a half. And finally, we have the deduction for interest on car loans, which is also for 2025 through 2028, provides a deduction of up to $10,000 for individuals who take out a car loan in 2025 or later. Interestingly, there's a new form out today. The IRS came out with a new form today for individuals to report these items on their tax return in 2025, Schedule 1A.
Now, I know there was talk in the state of New Jersey and the state of New York as well to impose taxes, income taxes, for people with tips as state taxes, not for federal. Obviously, the federal government decided not to tax it. Is that still in effect? Do we know that in New Jersey? Are they still going to tax tips so that people don't necessarily get as much of a benefit as they thought?
Yeah, so tips are taxable. The question then for New Jersey is whether they follow the federal deduction for tips, which is, again, a limited deduction, limited in amount and in duration.
Okay, so we keep our fingers crossed on that. We hope that New Jersey
Yeah,
and New York State both follow through and let the people who work hard and earn those tips keep those tips. That's one of the
exactly.
incentives, right, to take those jobs. Now, the SALT deduction, for those who don't realize, when you have a state like New Jersey or New York that have a state income tax, that's SALT, right? So the SALT deduction limit is higher this year. So how does that impact taxpayers in New Jersey and other high tax states?
Yeah, so it's very helpful for taxpayers in New Jersey, New York, California, Massachusetts, Illinois, the high tax states, as you mentioned. So this is back in 2017, the tax law had limited deductions for state and local taxes to $10,000. And so what the OB3 did, or the One Big Beautiful Bill Act, is for years 2025 through 2029, if you itemize your deductions, you can deduct up to 40,000 of your state and local taxes. So that includes property taxes and state income taxes. And so the way that works is you get to deduct $40,000. That will increase each year in 2025 through 29. So in 2026, for example, it's $40,400. But it does phase out when you reach a certain income level. So if you're a joint filer and your income is over $600,000, that increase phases out entirely and you're back to the $10,000 deduction. The last thing I'll mention about this is it's the pass-through entity taxes they still work. So they are still a valid and effective workaround. So if you have a business, a S corporation or a partnership, you can elect to pay taxes at the entity level and effectively get around this deduction limitation.
Now, there have been some changes, I believe, to how contributions to your 401k, including the catch-up contributions, they changed this year. So what strategies should people consider to maximize what they keep?
Yeah, so the deduction, the amount you can contribute to a 401k increased in 2025 and in 2026. But interestingly, new for 2025 is the new amounts that if you're between ages 60 and 63, there's what they call a super catch-up provision. So normally it was you can deduct a certain amount in 2025, it was 23,000, sorry, you can contribute up to $23,500 to an IRA. If you were 50 or older, you could do a catch-up contribution of 7,500. In 2025, this new provision says you can add up to $11,250 if you're between the ages of 60 and 63. In 2026, the amounts go up even higher. You can contribute up to 24,500. The catch-up increases, and that super catch-up stays the same.
That's a pretty good deal. That's you just think about how many ways the federal government thinks of picking your pocket. It's an amazing thing considering 150 years ago, income tax did not exist. Are there any
That's right.
limits that we should know about? Right. But then again, you wouldn't have a job. Uh, so we say it's a good thing. I have many
We call
relatives
it
who
the
are
Full
CPAs.
Employment Act for tax advisors.
Exactly. Are there any limits, by the way, that we should know about regarding gambling losses or charitable contributions?
Yeah, in what the new law did, the OB3 said in 2026 it imposes new limits on gambling losses and on charitable contributions. So for gambling losses, traditionally losses were limited up to the amount of gambling earnings. Now there's a new limitation: only 90% of your losses can be used. So for people who gamble extensively, this will create more taxable income for their gambling earnings. On the charitable deduction side, there's a new floor now that's subject to your contributions are subject to a new floor that's permanently lost. So that the new floor is 0.5% of your adjusted gross income is a new floor. So only contributions above that amount can be deducted for taxpayers who itemize their deductions.
Interesting. And we have about a minute left. What is a website for people to get more information to contact your company?
WITHUM.com is our website, and we have a lot of information there for individuals and businesses that explain these new tax law changes.
And what would you like to say to people, Dan, who wait until the morning of the 15th to contact their tax advisor about their taxes? The sooner the better, right?
The sooner the better. It's a busy time of year for tax advisors and tax preparers. So the sooner the better. And also you can start your planning opportunities. So tax compliance is one aspect of paying your taxes. Tax planning is the other opportunity, which we like to highlight to clients. So there is an opportunity here to save money and increase your deductions. So the sooner you start that process, the better off you'll be.
And a reminder that if you wait too long, somebody else who may hack into your account and get your social security number may apply or submit taxes as you and maybe steal a refund. So you want to get it in as soon as possible with your tax advisor so you don't have that, or at least you minimize that possibility, right?
Exactly
So
right.
that's the thing to do. Always. All right. Dan Mayo, partner at WITHUM, WITHUM. Thank you so much for coming on. Great advice and great information. We appreciate you.
Thanks for having me.